Hello, Craig. Thank you for being on the show today.
Thanks, Aurelian.
Would you be so kind to please introduce yourself for our listeners?
Sure. My name is Craig Henniger. I'm a commercial appraiser. I've worked with Colliers for the last 6 years now. And prior to that, I worked at a few other firms. And I've also worked at managing research for Colliers across Canada. So my background is fairly diverse in the commercial real estate field.
Fantastic. Could you please define for us industrial real estate? That's the focus for us today.
Okay, well, industrial real estate, I'd say really is anything that's warehouse-based or shipping-based real estate. It certainly covers a large area, and you even get to cross over with office sometimes, what we call flex office, where you'll have these industrial parks where there's a building that might even look like an office building from the front, and it presents as office because it's got some office space in the front, but at the back there's a lot of warehouse. This is very typical for multi-tenant industrial buildings and things like that. So industrial is, generally speaking, ground level or very few levels, and we'll talk about that in a little bit, I think. But it varies from office in that the leases tend to be larger, and there's a lot of throughput of goods and services or manufacturing within the buildings themselves as compared to other traditional real estate forms, which would be office, retail, hospitality, and residential, which are somewhat self-explanatory as well. But in an office, obviously, you've really got no industrial space. It's all about housing people to work. For retail, it's a shopping center or some kind of an area where there's a retail trade, and hospitality covers hotels and spas and things like that, and obviously multifamily and residential. So it sort of fits into that other area of built space.
Fantastic. So you mentioned leases. Can you tell us a little bit more about leases and in that space?
Sure. Well, just generally, it's pretty common for industrial properties to be owned by an investor and leased by a tenant. Although I must say in industrial, it's the class that is most likely to also have owner users. So it's a mix of people who own and occupy their own real estate for the purposes of conducting their business, and those that will rent space from others. And the traditional approach to renting space is you have a lease, which would range from, it can be very short term, month to month or annual, but typically most leases are 5, 10, or 15 years long, and they'll have renewal options. So as a tenant, you basically inherit most of the rights of the owner of the property, and your lease is a detailed contract that it spells out what responsibilities you have and what responsibilities the landlord has or the property owner has to allow you to conduct your business there.
And are these traditionally triple net leases, or how does that work?
It varies. There's really no rule on how you would write a lease. Some leases triple net or fully net leases. What that would be was where there's an agreement with the landlord where a tenant might pay $10 per square foot of occupied space, but they'll also pay all the property taxes, all the operating costs. They'll pay for insurance on the property. They'll pay for repairs and maintenance. They'll pay for snow clearing, things like that. Then there are a whole variety of things we would call semi-net lease or single net leases. And that just breaks down to how much of the additional expenses that the tenant pays versus the landlord. And then we also have gross leases, where a gross lease is if it says you're paying $10,000 a month, that's exactly what you pay. You don't pay any more, you don't pay any less. So it really depends on the type of space, the local market, and the preferences of the tenant and the landlord, how they structure a lease. But more often than not in Canada, a commercial lease tends to be a fully net lease.
Mm, thank you. And who are the big players in that space?
Well, it really kind of runs the gamut of who the players are. But if I was to break them down into groups, most Canadian pension funds and most global pension funds allocate a certain amount of their investment to industrial. It has tended to be a little lower than office and residential in the past. That may be changing with the changing world, but there is space for that. And then most companies that invest in large amounts of real estate want to balance their portfolio. So they have an interest in having industrial real estate as well as the other asset classes I've mentioned before. Um, in addition to that, there are lots of public real estate companies and real estate investment trusts, both which trade on the stock market, and you can buy into those. And those companies will either have a diversified portfolio, much like a pension fund, or they will be purely interested in investing in one particular type of an asset. So there will be industrial REITs, companies that only look at buying industrial property. And then the next stage, well, I shouldn't say next stage down, but another group is generally the private developer and property owner. And these vary more by city, where you're going to have key players in a given city. And they usually have evolved from having a large land base. And rather than just selling off their land, they also tend to develop for profit, where they will continue to own the properties they build and they will rent them out. So these vary across the country, but each city has got the 3 or 4 key industrial developers that are active in that market. And then you've kind of got also owner users, lots of companies that will acquire real estate once it's been built, or they'll acquire land, and that land upon which they will either build a building or they will get a contract for a build to suit, which is where a company will build the building for them and then hand over that property to them. So if it's handed over as a lease, we call it a build to suit. If it's handed over as an owned property, it's usually called a design build. But that's sort of like, it's a sort of a continuum across the scope, from starting with some ground, just dirt in the ground, and ending with a completed building with a tenant occupying it or an owner occupying it.
So why would people consider industrial as an investment? What are the strengths of this asset class compared to others?
Well, I think one of the big strengths of industrial these days is it seems to be somewhat impervious to the risks that come along with COVID. But that goes back to more what's being done with real estate and industrial real estate in general. As we consume things, we need to have those supplied and manufactured. And as the population grows, so too is the need for industrial real estate. In different markets, there are other focuses as well. Like, for example, in Vancouver, a lot of the industrial real estate is used for shipping throughput, where over 80% of the goods that arrive in Vancouver on boats actually ends up getting shipped out of the city and they continue on to somewhere else, but they often get repacked. And there's an active market in Vancouver where company will bring in 10 containers from foreign markets and they'll resort those into 3 or 4 domestic containers, which are larger. So we kind of get this shipping and receiving arrangement, often referred to as a cross-dock facility, is where you're going to have either containers or trucks on both sides of a building, and they can shuttle them from one to the other. So you might take 110,000 widgets in one container, and you'll break it up into 7 different containers going to other markets. Whereas in somewhere like Edmonton, there's a large amount of demand for fabrication when there's activity in the oil patch. They do a lot of manufacturing for exploration and development of the oil patch. And in Toronto, there's a lot of, in Montreal, there's a lot of shipping and receiving, a more traditional basis, but also construction. All this to say, it is less subject to the extreme swings in value and occupancy that you'll see in retail and office real estate, for example. So it tends to be a little bit more stable. For a long time, industrial real estate we weren't seeing much gain in rental rates, though, and there were a whole variety of reasons for that. But partly it's just because there was so much out there and it was easy to supply more industrial space. But as land becomes more constrained in the key markets in Canada, the land comprises a large component of the cost of an industrial facility, because they're usually only 1 story tall and they usually cover less than half the land. So you need quite a bit of land in order to deliver a building. But the land usually is good for store of value, and if you have to redevelop your building after 50 years, then you've got relatively small amount of building on the land. And what's happening in a lot of markets is those old industrial buildings from 50 or 60 years ago are now being redeveloped into something other than industrial or mixed use industrial. So it's a fairly low risk investment compared to some of the other ones out there.
Thank you. You mentioned a changing world. Can we go a little bit into this, where we see lots of evolution? I believe the vacancy rates are at historical lows in industrial. Can you speak to the history of industrial and where we stand today?
Sure. Well, I think that what's been happening lately is there's been a lot more take up of industrial space than what we'd seen in the past. And there's also a scarcity of land. So as we have more of a scarcity of land, particularly in Toronto and Vancouver, and this is largely influenced, although not completely, but influenced by government legislation to control development of large tracts of land. Toronto created the Greenbelt about 15 years ago, and Vancouver BC created the Agricultural Land Reserve in 1973. And these were to protect lands that would be used for farming, arable land from being just developed in large swaths. So this has created more pressure on the land. So I think that's what's happening is as the price of land has been rising, there's been less speculative development. And frankly, I think the market has also been surprised by how much demand there has been for industrial space. I think a lot of that may be coming from the rise of online shopping and fulfillment requirements, but there's no doubt that vacancy rates are unbelievably low. In Toronto, our most recent reports were around 0.4% vacancy. We did a piece in Collier's last year comparing the GTA market to other markets in the North America, and there's just no comparison. Toronto and Vancouver's vacancy rates are so much lower than what you're going to see anywhere else in North America. But Montreal as well, Ottawa's got an extremely low vacancy rate. And we also look at availability because there are two things we consider about industrial space. One is the vacancy rate, and that really refers to how much space is currently unoccupied. And then availability rate is how much space you could go and get if you needed to lease some space. So vacancy usually doesn't include property under construction. So at any given time, most markets will have between 1 million and the larger markets between 5 or 6 million square feet of space under construction. So even though the vacancy rate looks extremely low, the availability rate might be considerably higher. I think Vancouver's last year was around 4.5% towards the end of the year, up from below 2 at some point. So what was happening is there was a lot of space under construction, even though there wasn't vacant space today. If you wanted to lease space, and remember, these companies don't lease space to occupy tomorrow, they lease space to occupy 2 years from now to continue to occupy for 40 years or 30 years. Like they have a very long-term perspective. You can still find that space out there because what happened was the industrial plant, as it were, in Vancouver and in Toronto and in Montreal and other markets has really stepped up to recognize there's a scarcity. The other thing that's happened is there's been a really significant rise in rental rates that we hadn't seen for a long time. This is partly because we had seen cap rate compression, which cap rate compression is that at some point every investor requires a return on their real estate. And if you had a 10% cap rate, for example, that means you make a 10% return on your money every year. Well, as mortgage rates and bond rates has been dropping, so too have cap rates. So you could continue to pay the same amount of rent, but that rent would yield a higher value and you can build a more expensive building for the same rent on an extended period of time. So what we had seen was this cap rate compression was helping to alleviate the pressure on rental rates. Now we've kind of reached a point where that cap rate compression seems to have ceased. And in order for developers to continue to build property, they have to make a return on their investment. And then we are also seeing there's lots of other factors like the cost of steel tariffs that were popped up in 2018. And now there's some discussion about the potential for steel and aluminum tariffs. Again, all these things factor into impacting the cost of building buildings. And in the end, no developer is going to build a building to lose money. So there are a lot of these factors that are playing into it, but there's no question that the Canadian industrial market is very tight. Even markets in Alberta would be probably considered to be balanced by global standards of vacancy.
So you said cap rates are being compressed. What are they typically at these days?
It's very difficult to say. I mean, truly, it depends on the asset market itself. It depends on how you look at the national mix. But there's no doubt that cap rates have dropped significantly in the last 15 or 20 years. And it's just been a secular decline that goes along with the bond rates. What usually happens is the cost of building a building is influenced by the cost of borrowing money to build and to own. And that's influenced by the bond rates or the mortgage rates versus bond rates. So we refer to it as a spread, a cap rate spread over bond rates. And that tends to be in the 100 to 300 basis point range. And as we're starting to see long-term bond rates really hitting all-time lows, that again is making real estate as an attractive alternative to a bond because you're getting more return obviously you're taking more risk than a government bond, but there's trade-offs for that. So without putting any numbers, I like to refer to them rather than taking off the top of my head. There has been a secular decline over the last 20 years in cap rates, subject to annual bumps here and there.
Thank you. In terms of deal flow, do you see a lot of deals happening, like a lot of transactions in the industrial sector?
I think that I couldn't speak to all the markets right now. And obviously, in the last 3.5 or 4 months, the world has been very different from what it was before. But there is no doubt that the industrial market was probably the most active market out there of all the different commercial asset classes. There's still demand for property, and if anything, there's more demand for industrial fulfillment than ever before because of the rise of online shopping. So really, that's probably been the most active market. But by all accounts, from people I speak to, there was still a dramatic decline in the amount of activity in the marketplace compared to what would have been anticipated had we not been facing a pandemic.
And so you mentioned twice now e-commerce. Can you speak to Amazon and its growth and the effect on the industrial sector?
Sure. There's no doubt that Amazon has a big impact, but it's probably that impact is more magnified by so many other players as well. Amazon tends to come in and take a few key components. Like, for example, they built a new warehouse in Ottawa a year and a half ago, or they completed it probably about a year ago in the east end of Ottawa. Well, they've just announced they're going to have another huge warehouse built in Ottawa and Barhaven, just south of the city. So there's an example of how dramatic the growth of Amazon has been. But equally, so we've got to look at the other players in the market, because Amazon collectively does not occupy the kind of space that is in the industry out there. I heard some interesting news the other day about Walmart. They're really taking aim at becoming the Amazon competitor. And in Canada or around the world, but Shopify is another company out there that are looking to, my understanding is they're looking to move into the fulfillment side of things. Previously, they were providing the back website experience for buyers, so you could either ship everything and sell everything through Amazon, pardon me, or you could kind of private label everything yourself and use Shopify to enable you to continue to get your information out there, your goods out there. So that's another significant player in the market, and it would be interesting to see how it all comes out. And there are so many others. Wayfair built a huge warehouse in Toronto. There's just sort of, if you start going through the list, it's quite shocking the number of firms out there and the amount of volume going through the area.
Thank you. So as you said, so different players, and those players, do they typically, like when Amazon builds a new facility, do they own it, and how does that work?
I think it varies by city. Pardon me, and it also varies by the title they're permitted to have. For example, Amazon's built a new facility out in Vancouver, but I believe it's on leased land. So it's sort of, you'll be looking at long-term arrangements. But I think Amazon generally, will make a decision that's financially viable for what they're looking at and how big they hope to grow. But I can't really comment on the structures that Amazon put together. I'm not close enough to what's going on there, I'm afraid.
So there is no new supply. Will we see office or big box stores be converted to industrial? Because when we see the demand being as high as it is.
Well, I think you've got to, I mean, there is new supply, and there's new supply being produced in most markets. But it's also true that some of that new supply has already been pre-leased. With a shortage, I wouldn't be surprised to see some conversion of some retail space, because really this is just another form of retail. But again, it comes down to zoning restrictions. It's not as easy as saying, oh, well, that's got four walls and a roof, and we can use some space because there's parking. Every city and every municipality has their own zoning restrictions on how land can be used, parking requirements, and all sorts of things like that. So it would be ideal if we could take any underutilized space and sort of fill it up for that purpose, but it's not necessarily practical. And you have to consider factors related to the community, what kind of traffic is going through there, and the ability of shipping to get in and out of these facilities, because they require a lot of turnover. So access to key arterial routes is important. Although it's also this last mile delivery is another topic. So you're going to getting to have these sort of mini or micro fulfillment centers where there's an atomization of lots of smaller centers that are close to consumers, because we're certainly seeing a movement towards day of shipping. And so as they know which goods are going to be ordered frequently, there's potentially a movement towards that as well. So right now we've got the massive fulfillment centers, but they seem to be feeding into a bit of a hub and spoke network, where the desire is to be as close as possible to your end consumer, because consumer is demanding very quick turnaround.
I've heard you in another podcast, and you were talking about vertical solutions, where the idea was to condominialize and kind of creating different levels of space. Is it a thing?
Yes, absolutely. Really, it's more common. I mean, if you go to Asia, they've been doing this for years and years. Pardon me. But in North America, we're starting to see some. I understand there's been stuff, some buildings built in New York and Vancouver. We've got a couple under process right now where we're getting multi-level warehouses, and also there's the movement towards condominiumization, or in some markets it's referred to stratification, where you're not only having the warehouse on the ground floor, but you might have an office space, or you might have retail space, or just more industrial above it. One of the challenges with building these multi-level industrial properties is you need a big piece of land to build multi-level, because you've got to find a way for trucks to get up and down. They don't generally work with elevators. They usually have ramps around the exterior of the property, so that the upper floor tenant will be able to utilize the same kind of shipping and receiving that's required for the lower floor tenant. But we are starting to see that development, and particularly when I mentioned mixed use redevelopment in parts of Vancouver that are traditionally um, warehouse or, pardon me, industrial spaces, near Mount Pleasant, for example, just south of the city. Those areas are still zoned for industrial, but what's happening is buildings are being redeveloped with industrial on the ground floor, and maybe some more industrial or some office or complementary uses on another level, so that they can make more money out of the location or the proximity to downtown, because that's one of the challenges. Um, as we face a real shortage of land, and Vancouver is probably the most extreme example in Canada. We've got, depending on who you listen to, between 10 and 30 years of supply of industrial land out there. But when you consider the amount of land that's already covered in what we would refer frequently to as obsolete industrial buildings, which would be anything under 20 or 22 square or feet of clear height, those buildings just don't have high enough clear heights to accommodate the racking and shipping requirements of modern commerce. Those buildings are candidates for redevelopment. And so there's a lot of potential new space that could be developed in the existing land footprint if we can find a way to get there, but it costs more. So as rental rates rise, being able to achieve a financial return for developers on building multi-level property, it becomes more realistic. So we're starting to see that, and can't imagine that it won't continue, particularly when you look at the desire for a lot of these e-commerce firms to be close to their end consumer, and most of the end consumers live in close proximity to downtown, which there generally isn't any land available.
We're seeing, because there is so much demand coming from e-commerce, and so this sector of industrial is weathering pretty well during COVID. So during that type of recession, industrial weathers pretty well. You've mentioned aluminum tariffs. So what else can affect this sector? And was it recession proof during 2008? What are your thoughts on all this?
Well, I think in most of Canada, we didn't really experience much of a recession in 2008, to be honest. The real estate market recovered very quickly. And what we saw in values in real estate was there was definitely a drop in volume and some weakness in rental rates. But what generally we saw was a lack of consumer confidence. And when there's a lack of consumer confidence, investors require a little bit more return in order to do a transaction to buy a property. So that resulted in a rise in cap rates that lasted for, they rose for about, I think it was about 9 to 12 months, not dramatically, but within a year and a half of the actual beginning of the contagion, we had tracked back and we were seeing cap rates that were headed back towards the kind of lows that we had seen. And since then, we've certainly eclipsed those. We've gone far lower than the cap rates at the time. Is industrial a recession proof? I wouldn't say that it is. But in this particular case, the impact on the market has been that a large part of the population still is working, still has income, and if they're going to buy the things they want to buy, there has been a shift towards a lot more e-commerce, and that e-commerce is driving new shipping channels, and those new shipping channels need space. So if we built way too much industrial space, then we could have a problem. But right now in Canada, it's not looking likely. We've got strong population growth, but really there's no way to know what's going to happen, depending on how long the COVID-19 pandemic persists and how long we wait till we have a solution for it. But there's no doubt that if you're owning industrial real estate right now, you probably have a long-term tenant. You're going to be getting your rent for an extended period of time. And by the time your lease comes up to renewal, the market may have recovered. Whereas if you're buying, if you own a rental property, then you might have some concern over your tenant's ability to pay. But I think our experience has been when we survey our thousands of tenants across the country, the Colliers Property Management Group, the Real Estate Management Services Group, we found that large, a high percentage of even residential and industrial tenants are paying. And even within the office and retail sectors, it's really only retail that's been experiencing some problems. So it's sort of difficult to say, but right now we're in an environment where there's a lot more demand than supply. So that's a good time to own industrial real estate.
Thank you. So I don't know, have you guys had conversations at Colliers in terms of the future of office space? Because we see more and more people are staying home, working from home, and it's actually working, and they're not that less efficient than if they go into the office. People are thinking about new ways of having flex shared office spaces, like mixed use commercial real estate, where you would have a shared office space at the bottom of the condominium and then condominiums on top. Um, and then you have retail. Retail which is really suffering. We see a lot of shops suffering during COVID. Uh, have you have you been part of conversations at Colliers about the future of those two sectors?
Well, I think that, pardon me, I think that the thing to remember is that retail, I think, is doing fairly well en masse, but a lot of that retail demand has been manifested in e-commerce sales than the traditional in-person buying. So there's definitely some challenges, especially for smaller retailers out there. There have been a number of chains that have moved into bankruptcy protection and the Companies and Creditors Protection Act. But I'm not close enough to that to really make much more than that of a comment. In terms of office, I think the jury is out on what's going to happen in office. You've got firms like Shopify who have gone out and said that they are going to be a virtual employer from now on. They had been leasing, I think they had a lease for about 4 floors in one of the key office towers in downtown Vancouver. Now they've said that's going to be an employee onboarding location. The last I heard, it may have changed again, but there's no doubt that they, as a firm, are looking at the ability to do this. And there are some other tech firms that are doing the same thing. It also means they can hire talent around the world. They don't have to worry about getting them a visa to work in a particular location. But at the same time, there are a lot of firms out there that maybe have to have people working together. And there's a great deal of debate over what it's going to look like in the future. Are we going to have fewer people occupying office space? Very likely there will be some kind of a decline in the number of people who are full-time employees in office towers. What the size of that is, it's hard to say. Will they require more space per person? It's possible as well. So right now, I don't think anyone's got any clarity. There are a few firms out there saying that they're going to be online firms only. And I think that they probably will still have office space. There are other firms that are, that really firmly believe in people working together because they have a collaborative work environment, and they feel that that's best. We're only 4 months into an experiment that would probably take a few years to get a real clear view on. And if you start looking online, you're going to find supporters of both positions. So it's very difficult to tell. I think that right now it really comes down to a company by company experience and how well the employees can work and do their jobs in that kind of environment. But I wish I had some clarity on it, but I don't think we were there yet.
Okay, thank you. Okay, well, we have more or less cleared all of the questions. Is there are there any other thoughts you'd like to share with the listeners, or?
I think the only thing that to recall, if you're talking about industrial real estate and really any commercial real estate, you have to take a very long-term view of this. So one of the examples that I heard the other day in a meeting was we were talking about how the capitalized developers are out there buying land now because they're looking at 10, 15 years down the road. They need to have land to be able to continue to build. So when you look at short-term risks in the market, you have to really think with a sort of a mentality of something that's 5 to 20 years in horizon, rather than will I buy it now and sell it in 3 months? Even though you can buy and sell REIT stocks that quickly, real estate itself isn't that liquid. So any short-term issues can create cash flow problems for a property, but overall the real estate's still going to be in demand People need places to live. We need food to survive. And right now, the commercial real estate market is really accommodating that in a big way. We've got a lot of population growth coming to most markets. Will it continue post COVID? It's very likely that it will if they can find a solution for that. But if you're looking at anything, real estate is a sort of an essential part of human existence. So I think that that's a good thing to keep in mind. But again, it's hard to look at these things really short term. There's a quote from Benjamin Graham, who is sort of one of the fathers of value investing, and he said that um, the stock market is a voting machine, and you get the vote of the people who showed up that day to give their opinion. So when you look at the market and see that there are sales and the sales are at higher cap rates, or there's some doom and gloom out there, well, for every time there's a transaction, there's someone else buying that property and who have a contrary view of the long-term perspective. So it's important to kind of keep that kind of balance when you're looking at things.
Thank you. Well, thank you for those words of wisdom. Thank you so much, Craig, for the interview and for your expert opinion on all the subjects we've covered together.
All right. Well, thanks very much, Julia.